Hello, welcome to one of Milford's regular In Focus video series. Today we'll be discussing the Active Growth Fund, and to do that I'm joined by Portfolio Manager Jonathan Windust. Jonathan, it's been an extraordinary year this year. We've had a global pandemic, lots of uncertainty, a short, sharp recession globally, and lots of market volatility. Has this been the toughest year in the Active Growth's long history, and how have you found performance so far?
Yeah, it's been a very interesting year, Mark. So in the US at the start of the year, we had very strong economic environment. So unemployment was at 50-year lows, and then that switched. Unemployment actually rose to 90-year highs. So yeah, it's been a pretty difficult time to manage money, lots going on. We've been pretty pleased with the performance. So originally when the virus outbreak started in China, we were on top of things. We reduced risk in the portfolio. We didn't anticipate the sharp fall in markets that we had, the degree of it. But we managed through that period reasonably well. We did take some defensive actions. The portfolio fell a little bit more than we would have liked as things sold off a little bit harder than we would have thought. But since then we've done well. We've been in the right sectors, we've been in the right stocks, and the funds managed to outperform the market through that period. So yeah, it has been challenging but exciting, and there's been lots of opportunities.
And as we've gone through this whole crisis, it's become clear that some companies have benefited, in fact, from the current environment, whereas some companies are clearly losers. Can you talk a little bit about some of the stocks that you've been investing in to try and capture some of that performance you talked about?
Yeah, so the virus has definitely created winners and losers. So it's accelerated some of the trends that were already happening in the technology space. So the move to e-commerce, so things like Alibaba and Amazon have been clear beneficiaries. The healthcare space has been a clear beneficiary. So we've benefited by companies like Fisher & Paykel Healthcare in New Zealand, Thermo Fisher in the US, which is doing a lot of the testing, but also some of the oversold stocks, some of the stocks that have been directly impacted. There's been opportunities in those. So things like Kathmandu, for example, in New Zealand, we were able to take advantage of a discounted capital raising at 50 cents, and the stock's now well above $1. So yeah, lots of opportunities, lots of winners and losers. The stimulus from the central banks and the governments has really created winners as well. So the housing market is starting to boom, and we're benefiting from that through our holdings in the US's largest home builder, D.R. Horton, and also in home improvement. So as people are working from home, they're spending a bit more money on their houses. So things like Home Depot and Lowe's, which is sort of the equivalents of Mitre 10 and Bunnings here in New Zealand and Australia, have done well for us as well.
Good. And so you talked there about lots of companies globally and locally. So talk about how you harness some of the teams internally and the resources that you have at your fingertips to help you select some of those companies from whichever region you might look at.
Yeah, that's the great thing about Milford now. We've got a massive team of 28 people. So when things happen, we can be on top of it. You've always got the person at Milford, someone's going to be an expert on what's going on. So that, for me as portfolio manager, that's great. I can get the best ideas that are coming from the different teams and put those into the portfolio. And we can react quickly, so we don't have to get up to speed. Someone's going to be up to speed, both on the equity side of things, but also on the fixed income side of things. So yeah, we've got people, sort of dedicated people, sort of following the virus and following the potential outcomes from the vaccines as well. So that was really helpful for us in the early days.
Okay, and let's think about where we are right now. You know, share markets have recovered. The pandemic's still rolling on. There's still lots of uncertainty. We don't really have any hard progress on a vaccine. So where are you positioned at the moment, and how do you see the outlook?
Yeah, so as you say, the short term is very uncertain. The economic impact of the virus is negative in the short term, but at the moment that's being offset by stimulus. So the two are almost sort of netting out. Valuations have got back to sort of more sort of normal levels, but we still have high levels of stimulus on the other side of that. So the short-term outlook for markets is uncertain. We've got the election as well. So a bad outcome in the election would see some of that fiscal stimulus not come through, so the markets may take that negatively. So in the short term it is very difficult. So we've taken a little bit of profit on some of the shares. Last month shares had a good run coming into the month, so we've reduced our exposure in particular to the US share market, which has done well. But yeah, we're pretty close to our normal levels invested in shares, just moving around where and which markets we're invested in.
And on the fixed income side in particular, are there any opportunities that you're seeing there? The fund obviously has a small allocation to fixed income.
Yeah, the fund typically has 10 to 15% in fixed income. At the moment, we are actually seeing very good opportunities in some of the high yielding fixed income. Now, these are companies like Centre that owns the Westfield malls around the world. And actually the Centre group now is just New Zealand and Australian malls, but that came out with an issue last month at over 5%. So we think the risk reward of that is very attractive relative to low interest rates. So we are seeing opportunities there. Also, some of the banks, their subordinated fixed income paper is also yields above 5%, which for the risk we think is very attractive in this environment. So we're active and we're looking to add to those.
Okay, and let's think about a little bit longer term. Obviously share market valuations are reasonably expensive. Economic growth might be a little bit lower going forward, and interest rates already extraordinarily low. So what do you think the long-term outlook is, and what are the opportunities for the Active Growth Fund?
So the medium term, the virus is going to pass. So we're going to have to start moving from the winners to some of the losers. So that's going to create opportunities for the fund. So banks have been a big underperformer, but as the virus fades, as some of the bad debts come down, that's going to create opportunities for us. So we're increasing our research on that area of the market. Equity valuations, as you said, they have risen, but relative to very low interest rates, we think the valuations of the equities are fair. Some parts of the market are expensive, some parts of the market are cheap. So we're moving obviously towards the cheaper part of the market, and banks fit into that. So yeah, lots of opportunities for the Active Growth Fund, and we think if we're active, we're harnessing the 28 strong investment research team, we can continue to outperform the markets. Returns may be lower, but we think returns above the alternative, cash and fixed income, will be attractive for the fund going forward.
Fantastic. Thank you very much.
Thanks, Mark.